Okay, this problem asks us to handle a lot of transactions having to do with our equity accounts. First, it gives us the capital structure of the company. You see what we have. We have preferred, we have common, we have retained earnings, and we have some treasury stock at cost. We have no additional paid-in capital treasury stock, so if we sell treasury stock for anything less, we have $41,000. It's 4,100 shares. That's $10 a share. If we sell it for anything less than that, we'll be reducing retained earnings. So let's take a look and see what it's asking us to do. So we'll go through these one by one. On March 3rd, the Board of Directors declared a property dividend of 255,000 shares of Lisco International stock that it had purchased as an investment. Its book value is $744,000. I'm not sure what that means, but I'm going to jot it down because I have a feeling we're going to need to think about that. So, book value $744,000, and the investment shares had a fair value of $3 per share. So the current value is $3 per share, and were distributed to shareholders on March 31st. So it's distributed to 31st. This is March 3rd, and the date of record is March 15. Okay, so let's just to be safe, let me make sure that we have this. So we purchased 255,000 shares. So we purchased 200, let me clear this so you're not confused. 255,000 shares is what we purchased, and the value of them as of the date of declaration is $3. So that's $765,000. So the book value on the declaration date is $765,000. We have a $21,000 gain that we have to recognize right now. So there's our first journal entry. I have to increase my investment by $21,000, and I have to recognize a gain of $21,000. Okay, now on March 3rd is the declaration date, okay? So once we've recognized the increase, now we recognize the reduction to retained earnings and the property dividend payable, $765,000, because that was the book value when we said we're giving them away. We recognized the gain, and then we distributed them at fair market value at date of distribution. Okay, then March 15th is the date of record. So that's date of record. There's no journal entry there. There's no journal entry for the date of record. Okay, and then on March 31st, we actually give these shares away. So what we're doing here is we're reversing that entry. So we're going to debit the dividends payable and credit our investment in Lisco stock. Okay, so that's the steps. Recognize the dividend, then declare the dividend and record the dividend payable. You have to announce the date of record, no journal entry, and then we get rid of it. Okay, now let's see what else we've done. On May 3rd, there is a 5-for-4 stock split. Well, 5-for-4 is a 25% stock dividend. You had 4 shares, now you have 5. 25% split. 25% split does indeed hit that large stock dividend. So we have to do it at par. So we have to figure out how many shares we're going to be giving out to figure out what we need to do there. So let's take a look. Altogether we had, if you look up at the top here, we had 414,000 shares at $1 par, but we have 4,100 shares in Treasury, so they're not outstanding. So it's 414. That's how many shares were out, but 4,100 of them are in Treasury, so we have 410,000 shares outstanding. So we're going to be distributing 25% of that. So, and we're going to do it at $1 par, so 25% of that. I can't do that in my head. Should be able to, but I'm old. So 410,000 410,000 times 0.25 is 102,500 times $1. So that's the value of the stock that's distributed, 102,500, done at par because it's a large stock dividend. So we will recognize that we're going to reduce paid-in capital, 102,500, and we're going to recognize 102,500 common stock. Okay, now notice that we go to the excess or the additional paid-in capital. We're still coming out of common stock, but it's not coming out of retained earnings because this is a large stock dividend. So large stock dividend, first thing we do is we reduce the additional paid-in capital for the shares, and then if we're all done, then we go to retained earnings. Remember, FASB wants to make sure that we're not misleading people, and we could indeed be doing that if we were to take large stock dividends out of retained earnings, especially if we did them at market value, and put them to paid-in capital. Okay, so that's what they want us to see. So we're actually reducing paid-in capital by that, but by the same token, the increase in common stock appears to increase paid-in capital by the same amount. So it's net effect zero, no impact on shareholders, won't mislead them. Okay, on July 5th, a 1% common stock dividend. Now, 1% common stock dividend, clearly small stock dividend. The market value of the common stock was $10 per share. Okay, so 1% stock dividend. So we have to come up with 1% of the stock. So we have 410,000. Remember, we had those. So let me just jot that down here. For our 1% stock dividend, we have to figure out how much shares are out. So we had the 410 that we talked about, But remember, we also gave out 102,500. So we had out there 512,500 shares. That's what we had out there, because that was the original number. That was the stock dividend, the large stock dividend, 25%. So that's the number of shares that were out. 1% of that is 5,125 shares. So that's how many shares we'll be giving out right now, okay? That we will do at market, because that's a large, that's a small stock dividend, 1%. So we will indeed, FASB will let us take that out of retained earnings. And we can do it at market price. So we're giving out 5,125 shares at $10 per share. So that's $51,250. The common stock is $5,125. And the additional paid-in capital, the difference between these two, is $46,125. Okay, let's take a look at our next. The board of directors, and this is December 1st. The board of directors declared a 7% cash dividend on the preferred shares and a 50-cent per share to the common shares. So let's take a look at that. So we have to look at the retained earnings and the additional paid-in capital that we're going to be giving up. So we have, look at my notepad again here. We have 7% preferred. So we have that. And how many shares do we have out? We have 91,000 shares out. And that's dollar par. Okay. So we have to come up with the cash dividends. You multiply that all out, we come up with $6,370. $6,370. So that's the dividend for preferred shareholders. And we'll do the same thing for our common shareholders. Now the common shareholders are going to get 50 cents each. But remember, we had 410,000 shares, plus we gave out another 102,000 shares, plus we gave out another 5,125 shares, and when we multiply that all together, we have 517,625 shares outstanding. Each one of those gets 50 cents, okay? So when we multiply that by 50 cents, we come up with $258,812. None of this stuff is hard. You have to remember to go through in order. So let's do the journal entries for all of that. So on the date of declaration, we're going to add these two together, just for the sake of simplicity, okay? So we're going to have retained earnings, or I'll tell you what, let's just keep them separate for now. So we'll do just this piece first. So we have retained earnings, $63.70, and dividends payable, $63.70. There's no journal entry on the date of record. When we pay them, we're basically reversing this. So we're debiting the dividends payable of $63.70, crediting cash for $63.70. The retained earnings for the common shareholders will do the same exact thing. We're going to have the $258.12 retained earnings. $258,812. I think that's what I worked out. Then we're going to have the date of record, no entry, and then when we pay it, we're going to reverse this. We're going to have a debit to dividends payable, $258,812, credit to cash, $258,812. So, not tough, detailed. You had to remember all those little pieces, and as they give you some information, you have to remember to grab it. Okay, the last thing it asks us to do is to, based on what we have and based on our beginning capital structure, create a ending shareholders equity section. Well, it's going to look just like this. Let me walk you through this so you see where all the pieces are and why the pieces are where they are, okay? This we just picked up from there. So we picked up that from there, 91,000. The paid-in capital preferred is the $521,725. What that is, it's the shares at dollar par. Then we had figured all of those out, and we came up with 521,725. Okay, so remember that includes the treasury shares. We really had 517,625. So this number here is 517,625 plus the 4,100 treasury shares. Paid in capital is just the computation, okay? It's the numbers we had figured out earlier. The retained earnings is this minus the dividends, okay? So that's the $9,045,000 minus this $765 minus the $51,250 minus the $6,370 minus the $258 plus we have to account for the net income and where do they tell us the net income? I've got it somewhere here in my notes. I don't know where it is. Maybe it's in the problem. So we include that. I'm not so much concerned about that, but that's what that is. You have to make sure, and these are the pieces that I really care about, the retained earnings balance. Remember, you have to increase it with income, reduce it with loss, reduce it with dividends. Okay, good luck.